The statement of cash flows is one of the four main financial statements, the others being the income statement, the balance sheet, and the statement of shareholders' equity. It is probably the trickiest of the four to put together and for students to understand, but I want you to have no fear because I'm going to walk you through how this is put together, and I'm going to give you a concrete example so that when it comes to taking a test, you'll have no problem acing the cash flow questions. Okay, so what it does is it reconciles the beginning and ending cash amount on the balance sheet. And it does this by breaking it down into three sections. So there are three primary sections of the statement of cash flows. There's cash flow from operating activities. This is just the day-to-day running of your business. The cash flow from investing activities. This is the cash generated or lost through CapEx, capital acquisitions, property, plant and equipment, or the disposal thereof. And then the third one is cash flow from financing activities, issuing stock, issuing debt, repaying stock, repurchasing stock, repaying debt. Okay, so the way it's put together is we use this indirect method. And so we start with net income, and then we back into the cash flow number. Now, net income, we have to remember, and I went through this on the income statement video, it's not cash. Okay, net income is not cash because we use accrual-based accounting. And so there are some things that, for example, we have non-cash expenses. And so there, right there, it's not going to be the same thing as cash. We have non-cash expenses like depreciation, and then we also sometimes get unearned cash advances. So that's stuff that doesn't go on our income statement, but it is cash. So we got to add that back in. There's also non-cash revenue. So anytime you see accounts receivable go up, that means you're booking revenue, but you're not taking in cash. All right. And you have to now subtract out short-term net investments such as in inventory. You have to subtract out long-term net investments, which are in CapEx. So none of these, the inventory or the CapEx, neither of those hit your income statement. So we got to adjust for that. And then at the end, we have to adjust for the issuance and repurchase of equity, debt, and dividends. So that's a lot of stuff to think about. It's much easier when I go through an example. The stuff there at the top is cash flow from operating activities. The CapEx part is cash flow from investing activities. And then at the bottom is cash flow from financing activities. Okay, so let's go through an example. Here is an income statement. And this was the same income statement that I produced in my income statement video. And you see we have net income of 22. And then we also have a balance sheet here. So this is a hypothetical balance sheet. We're showing 2023 on the far right and 2024 on the left side. Okay, so you will notice that the cash went up here by $6 between 2023 and 2024 on the balance sheet. So really what the statement of cash flow is it figures out why that went up. It shows you everything that happened that caused cash to go up by $6 during the year. We're going to start with $22. That's the net income. And then we are going to start adjusting for investments in working capital and CapEx. That's up there. And then we're going to take a look at any issuance and repayment of debt, equity, and dividends. Okay. So let's go through this. Here's the balance sheet again reproduced. Now let's go through this. We're going to start with net income, right? So that's going to be at the top. So it's that $22 you see right at the top. And we're going to add back in depreciation and amortization. Now, depreciation and amortization is usually just part of the income statement. It's not broken out separately. And so what we find here is I'm showing you we have $4 in depreciation and amortization. That's going to be jammed into the selling, general, and administrative expenses. It's just buried in that number somewhere. So we have to show what it is here. On the statement of cash flows. You'll always find this number, depreciation and amortization, on the statement of cash flows. The other thing that we've got here, now we've got accounts receivable have gone up by $6. Okay, so here, think about it this way. This is stuff that increased our income because accounts receivable it's revenue, but you haven't received the cash yet. So you delivered the product, you booked a receivable, you booked revenue, but and that raised your net income. It caused this number to go higher, this net income number, and it raised that number, but it didn't increase your cash. So now we got to subtract out what that increase was, just the increase in accounts receivable. We got to take that out, okay? So the other thing is, look at inventories. Inventories have gone from 620 to 625. When you buy inventory, that is not an expense. It's only an expense when you sell the product and it becomes not inventory. When you write inventory down and you run it through your income statement as cost of sales. So when inventory goes up, that is really an investment in the firm, but it is not reflected in the income statement. So we have to knock this number down. An increase in inventory causes you to reduce your cash flow from operating activities. Prepaid expenses are very similar to inventory. It's money out the door. It's money that you wired to somebody, but you didn't receive the product yet. You haven't run anything through the income statement. You haven't expensed anything. So I've got to write this down. Basically, what you will see is any increase in short-term assets, any increase causes cash flow to go down. Conversely, if I were showing any decreases in short-term assets, cash flow would be going up. Okay, but in this case, in all three cases, the asset went up, and so our cash went down. The sign is going to be flipped with liabilities. Any increase in a liability leads to an increase in assets. So let's think about accounts payable here. Accounts payable went from 445 to 460. Okay, so this is something that we bought, but we never wrote the check. So these are a lot of expenses, accounts payable, and we just haven't written the check yet. And so because of that, we get to increase our cash. Okay, we get to increase our cash because the cash, we kind of knocked it down in net income, but it really hasn't left the building yet. Okay, that's the same thing with accrued expenses. You can think of like wages. People, the company will write down income by wages, but they haven't written the check yet. You get paid every 2 weeks or once a month. So, as these wages go up over time that they owe, they will take a hit to earnings, but they won't take a hit to cash. So we got to now boost the cash here, right? Because we haven't written the check yet. So any liability that goes up, we are going to increase our cash. Any liability that goes down, we're going to reduce our cash. So hopefully that makes sense, because that's probably the trickiest part of the statement of cash flows. So we look down here, and the CapEx, sorry, I kind of jumped ahead with that arrow, but the CapEx we're writing as a $7 outflow. It could be in millions. Let's say we're expressing this in millions, so it's $7 million in cash flow. Dividends we're expressing as 17. These are just items that will show up here. They won't show up. You won't be able to find this number in the income statement or the balance sheet. You won't be able to know what these numbers are. So you're going to find them reported here on the statement of cash flows. And so when I take this $30 in operating cash, so we started with 22, we added in 4. We subtracted out 6, 5, and 5. We added in 15 and 5. So if I add up all this stuff here, it adds up to $30. I subtract out 7. I subtract out 17. I get change in cash is $6. Cash flow from operating activities plus cash flow from investing activities plus cash flow from financing activities is an net increase of $6 in cash. Okay, and so we have a match. That is the same number as, of course, going from 12 to 18. So that's perfect. Everything added up. Now, one thing that I will also note, take a look at property, plant, and equipment in 2024. Okay, you see it over here. It's 2987. It went from 2984 to 2987. Well, how do we get that? We start with the 2984 number, the 2023 number. We add in the CapEx, because that increases our property, plant, and equipment, and then we subtract out depreciation. That's how much we wrote our property, plant, and equipment down by. So that adds up. That ticks and ties with what we were reporting on CapEx and on depreciation. And then the other thing is on retained earnings. So if you look on the balance sheet down here, we have 25.23 in retained earnings in 2024. We started with 25.18. So 2024 retained earnings is simply going to equal 2023 retained earnings plus net income minus dividends. Okay, so this is all the earnings that we've retained. We haven't paid out in the form of dividends over time. So remember, we had 22 in net income, we had 17 in dividends. So this also ticks and ties. The retained earning number ticks and ties. So everything adds up. Everything is nice and tight, and that's what you need. You need your balance sheet and your income statement and your statement of cash flows to all talk together, to work together symbiotically. Okay, so if you do all this stuff, you will get the right answer. So if you like this video, please subscribe to this channel. This is where I make finance fun for students, and also give it a thumbs up. I look forward to seeing you in future videos.